We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Axel Merk, founder, CEO, and CIO of Merk Investments. Thanks for joining me today, Axel.
Hey, good to be with you, Tom.
Excellent to have you back. So, I wanted to start by asking how closely gold and real rates correlate. In one of your most recent gold chart books, you have the chart of gold on top of real rates. So is this signaling for lower gold prices here?
Yes, we publish a gold chart book every month to just for consistency look at the same sort of charts. It imposes a certain type of discipline. And as you can see on the chart there, right, these correlations work until they break down. And if anything, yes, they might have been a prelude to the recent drop in the price of gold. As you can see here, it's over 1,800. And as we're talking, it's just below. How do you value gold? And by the way, the real rates, to just clarify that, this is looking at 10-year real rates. Mm-hmm. Obviously, many people are saying, well, you got to look at the short term, how it is relative to inflation. But and you can argue any one of these things. But the reason why we like to look at the longer term one is because any investor asset prices, right? You discount the cash flow. Well, obviously, gold doesn't have a cash flow, mm-hmm. but it competes with treasuries. And if treasuries give you a real yield, a real return, why would you have gold? Whereas if it doesn't, we have financial repression, then gold might be more favorable. Mm-hmm. And so it's one of the many indicators that I think are worth looking at. And yes, there has been a divergence. These divergences do happen. And gold has held up quite well. But in the short term, maybe this is a sign that the real rate indications have overdone it. And indeed, as we are talking, the real rates have come back down. And let me just look that up on my fancy Bloomberg, right? We're at 57 basis points, 0.57 right now. And a lot of people are saying, hey, yep, maybe the upcoming Fed rate hike might be the last one in the cycle and will come back down. Mm-hmm. And so these are reference points, right? I mean, I'm not suggesting that everybody sell all the gold now because real rates are going up. You may want to do that if you think that real rates are going to go much higher from here, mm-hmm. and the Fed is going to be tough through eternity. But it's just one reference point. I think that's helpful to look at.
Mm-hmm. So could it be maybe more instructive if we looked at a longer term chart of this to see where those divergences have occurred?
Except we don't have, in this case, tips for longer than that. And so that's been the key reason as to why that is, why we don't have that. Mm-hmm. And some people, of course, say, hey, the tips yielded themselves. They've been manipulated with all these purchases that are out there and whatnot. And again, yes, that may, and then the CPI doesn't capture inflation anyway. These are just reference points, right? That's why we look at them. We have two different scales here, obviously. These are relative price moves. Generally speaking, intuitively, right? If you don't get compensated for holding cash, then holding a brick that just is may be worth it, right? Mm-hmm. I mean, that's the short of it. And that's why we hold, and also gold, we look at gold as a diversifier, right? And of course, if you invest in some wonderful high-tech startups that's going to conquer the world, maybe the returns are higher. But and to me, gold is more of a defensive asset. And it's been doing quite well over the years relative to cash.
Mm-hmm. So, Axel, when we think about real rates and, take into consideration the inflation side of that equation, do you see gold as being that inflation hedge? I mean, we've heard that many times, but, this chart, other than this divergence, kind of shows that it does act in that way. Is that the right way to be thinking about gold as an inflation hedge?
Well, yes. So that's exactly it, right? I mean, people get frustrated. Oh, inflation ticks up today and gold doesn't move up. What happens when inflation numbers are released? Again, it's forward looking. At the initial market reaction, when inflation numbers are higher than expected is that the currency of that country moves higher and gold may even move lower. Mm-hmm. And the reason why that move happens is because the market says, all right, now the central bank is going to do the right thing. They're going to raise rates and make sure inflation is not going to happen. And that's why these forward-looking indicators are important, because ultimately, the currency or gold will then do more what the Fed will actually do only in the weeks and months afterwards. Mm-hmm. And so people that look at this instantaneous relationship are often getting very, very frustrated. Now, Mund or Bert maybe on these longer term indications, right? I said, nobody knows what inflation is going to be like in 10 years, and certainly not what real rates are going to be like either. Mm-hmm. And so anything that goes more than, let's say, 5 years or so, all of that is more a reflection of the confidence in the Fed. And so if 5 year inflation expectations, so you step 5 years out in the future and look at further inflation expectations, if you look at those, they're really a reflection of what people think that the Fed is going to do. And that's also why the Fed panicked a few weeks ago and suddenly came up with a 75 basis points rate hike, mm-hmm. is because they saw that consumers were starting to lose confidence. Consumers obviously don't look at these charts, they look at the price at the pump. And when they see the price at the pump go through the stratosphere, they freak out, rightfully so, right? There's something is not right. I mean, they felt it, and now they see the confirmation. They felt it for years that something is not right, and now they see the confirmation. And so that is why the Fed is playing the tough guy right now. But of course, the market have given the answer and saying, not so fast. Now we're going to have a recession. Now it's all going to be bad. Mm-hmm. And so they're going to have the next pivot probably in the near term. But and so in that sense, yes, these longer term inflation numbers, real yield numbers are a perception thing. But of course, that's what investing is about, right? It's the perception of what's going to happen in the future. And so I think real rates are helpful in that. And looking at the short-term inflation number obviously tells you a lot of things, but it's not going to tell you the price of gold is going to move tomorrow.
Mm-hmm. Yeah, and I mean, as you're saying that future expectation of the markets, the Fed really has. I don't know if you would call it a problem in that they're telegraphing what they could do in the future. So does that move markets a lot more than what their actual actions are? They're telegraphing what they could be doing in the future.
I like that stutter you had there, because that's exactly what the Fed is doing, stuttering. I mean, the Fed tells us where they want to be. Mm-hmm. They don't really tell us how they're going to get there. Mm-hmm. And so, yes, of course, they have a bazooka. They can do anything. I mean, not fine-tuning, but I like to call it sledgehammer these days more than a bazooka. But Mervyn King, the former head of the Bank of England, has phrased it well, I think. He said central banks in recent years have relied on the market's confidence in central banks and pursued policies that are not very prudent. So by keeping rates at zero, saying, hey, we can push this economy further, inflation is not going to be a problem, trust us. If something goes wrong, we can fix it. Mm-hmm. And Mervyn King says, well, it would be much more helpful if central banks pursued policies that were prudent in the first place, because that instills confidence. And so the things that central banks and the Fed in particular is doing is really they're shooting off the hip. They don't have a big framework. The only thing they do is they blame the models. So the models didn't forecast what happened here. Well, that's not exactly right. They just wanted to listen to the models that they preferred. Mm-hmm. And they come up with these exotic things. And so it's not very helpful, I think, in that context to then say, they're going to do the right thing going forward. Well, what is it? What is their reaction function, the academics say? And Powell hasn't really said that. I mean, the latest minutes say, we're going to kind of look how things go. Mm-hmm. And that's not exactly good enough, especially in a high inflation environment. And then I'll talk about that more, but I think you want to get the question in here.
Mm-hmm. To your point about blaming the models, I saw Powell came out the other day and took blame away from the models. He said there was nothing wrong with our model, but nobody could have seen the virus happening and inflation being so high. But our models there was nothing wrong with our models,
Larry Summers did, I guess. I mean, and he made a very basic economic case for it. That was very vocal before inflation broke out, right? I mean, it's one of these things. You don't see it if you have an idiotic, backward-looking framework. And Bernanke, he just published a book. He started writing it before the pandemic, and then had to add chapters about high inflation. But it's just in the first section of that book, he writes about that all the things we have done to date since the financial crisis are really just a baseline for doing more. And he really thinks that we should do anything to maximize employment, and efficient capital allocation is really just is really not relevant as long as we get maximum employment. It reminded me a lot of the planned economy of the Soviet Union, what he's envisioning. But and let me just mention that one important thing he does mention about high inflation environments. He first says, and he points out, and I think that's something that Powell hasn't distilled yet. When the Fed has these models, they talk about demand in the economy, whereas the shock we've had is a supply side shock. The former head of the Bank of Mexico, when he was at an ECB conference last week, and he talked about that we don't understand supply shock sufficiently. And Bernanke says supply shocks are stagflationary, right? They raise both inflation and unemployment. And central banks just are not very good at handling it. And the proof is in the pudding, right? Now, where I strongly disagree with Bernanke, he wrote an editorial in the Wall Street Journal the other day talking about how much smarter we are these days, right? We understand the 70s, and everybody who listens to your program has heard that. We are so much smarter, we'll do this. The reason why we are not, so we might be smarter, but that doesn't mean we act any better, because the politics of stagflation are such that when you're hit with a supply shock, you're not going to throttle demand, right? You're going to write a stimulus check to help people pay the gas, which of course makes the problem worse. You introduce price controls and this sort of thing. So the politically attractive reaction to a supply shock exacerbates the problem. And that's exactly why this thing is not linear anymore. You have this overshoot in inflation, and then you have the ripple effects to the economy, and then you have policymakers make things worse. And that is why the 70s lasted a decade. And that's why this is not like, oh, high inflation is there. Now the year-over-year comparison, we'll get an inflation print in coming days, going to be lower. All the problems are over. No, the problems are not over, because we policymakers will continue to add fuel to the fire with some policy that's just not looking at economics 101.
Yeah, and again, to your point, I think that's a perfect example of the way that policymakers don't learn from the past. If you look at, examples from the Great Depression, I think is a good place to look, where price controls were introduced, checks were or stimulus checks were introduced that had the exact orthogonal effect of bringing down inflation and really getting those problems of that time under control. And we're seeing that again, right?
Yeah, well, I mean, the 1970s are a little closer, but yeah, they were price controls. We blame companies for making too much money. You got to encourage the increase of supply. You don't do that by bashing them. Now, again, politically, yeah, you'd love to blame somebody, right? And you're not going to blame your own policies. The other part of it that I don't think is talked often enough about is it's one thing that the Fed has to do its job, and I think they have failed in that. But on the fiscal side, right, when people lose confidence that the fiscal situation is sustainable, that also increases the problem, right? That induces inflation as well. And I see very little there in terms of prudent policies. We have all this talk that's populist rather than reasonable. And so, but what it means, I mean, for the price of gold and the like is, it's going to be a volatile period, right? Because we're going to have these swings where people say, "Oh, everything is under control," and back off, right? And then a few months later, some inflation numbers are going to break out again, and people realize that no, things are not back in order.
Mm-hmm.
And so eventually we'll fix some of these supply issues. Eventually we'll fix this and that. But these ripple effects are going to last for a long, long time. And in the meantime, of course, we've learned that spending money is great because you can spend trillions and nothing happens, except in the short term, we'll probably get gridlock in Congress. And so it's going to be a bit all over the place.
Mm-hmm. So when we look at this chart, for example, global M2 supply versus gold, are we due for a divergence in this chart as well?
Well, as you can see in this chart, right, money supply over time is bound to grow. But for now, this signals that we might have a contraction here, right? And again, on the one hand, it's nice to look at these charts, but you see that the divergences can be quite astonishing from these things. So I wouldn't overinterpret anything in these short-term moves. Mm-hmm. But yes, the money supply has come down of late, and that is in part due to we overstimulated things during COVID, and now we're going to have some volatility as things normalize.
Mm-hmm. You had mentioned a little bit ago, looking at different countries' currency growth or just currencies in general, maybe versus gold. So do you find it helpful to look at the price of gold in different currencies?
I actually don't do that so much. For me, gold is not the thing that changes, right? Gold is the constant thing. Everything around it changes. Mm-hmm. And I tend to look at the G10 space amongst, we do a lot of work on the currency side, and we think the G10 space is somewhat of a closed space. Now, obviously, yes, I do see what other people are publishing when they show the price of gold reach a new high in the currency, and of course it matters for the domestic demand when people lose confidence in the respective currency. But the US is obviously still a very large play out there, and from that point of view, in much of our research, we focus on it domestically. We look at it, yes, but it's not driving our research.
Gotcha. So there's one more chart here that I wanted to go over, and this is gold miners relative to gold. So do you use this chart to really base any decisions, or is this just, another counterpoint or another flagpost, if you will, to help determine where we are, let's say in the gold miner cycle?
Well, it's just a sign of where we are, a sign of the times, right? I mean, the gold miners have been out of favor. And then even as they came into favor, they didn't really outperform the price of gold. And part of that is that the majors in particular, the balance sheets are just too good. Part of the reason why people buy gold miners is because they want to have a leverage towards the price of gold. Mm-hmm. And they don't quite get that when the gold miners are hugely profitable and don't either return the cash or reinvest it by buying new ones. And so the gold mining companies, when they can afford to, they do what their investors want. And so investors told them, you got to get your house in order. And so that's what they did. And so they don't have quite as much leverage to the price of gold. The other part, of course, that is a challenge in the gold mining industry is always, it's very commodity intensive, energy intensive. And so the cost of mining has gone up of late. That's been a bit of an issue. But the short of it, to me, the broader context is the big companies have been underinvested. And so when we've looked at that sector, we've gone downstream to the explorers that they need to be acquired. Now, that is a highly speculative place. And in the current environment, of course, is more hostile to raising money. These small explorers need to raise money all the time. And so we need to see more acquisitions and mergers. The big ones haven't been buying. So we think the second tier companies will probably do more mergers, but the market hasn't been very kind to some of these merger announcements. Mm-hmm. And so that doesn't exactly encourage them to happen at a rapid pace, but they have to happen sooner rather than later, because these mines will get depleted. And so these mining companies want to be in business. And so if anything, this means to me that we're not late cycle in that spectrum, right? To answer your question.
There was actually one more chart that I wanted to go over here. And I just wanted to ask how you look at the CFTC speculative positioning here. How does this inform your view on gold?
this to us, this is like so many other things. It's a reference point, right? First of all, as most are aware, these data are published with a lag. Every Friday, you get the positioning data as of the previous Tuesday, and so this isn't exactly useful for trading. But it is a reflection of where the sentiment is, and sometimes you see extremes in these markets. But overall, this is a reference point. And I'll just leave it at that, right? It's a good reference point to see where things are. We obviously had some disruptions in the markets with COVID. And I'm not encouraging anybody to trade these derivatives, but the small print matters in these derivative markets. We've seen that in some other commodities that have some issues. But yes, this shows one can look at what the interest is in the space, get a little bit of a sentiment, but no, I don't look at it as a trading indicator.
Excellent. So, Axel, if we're in a, let's say, a deflationary environment for commodities and metals, what do you think that thing has to break for the Fed to reverse course here? Earlier we talked about that the Fed might be reversing course here, or you were saying that the bond market kind of senses that. So what do you think their actual, let's say, catalyst would be for that?
Deflationary environment for commodities. I don't think we're in a deflationary environment for commodities, but what we do see is we've had of late, of course, some commodities come down quite substantially, in part because of this very assertive move by the Fed, which has inverted the yield curve, right, on both the 2-year, 10-year, and 3-year, 10-year basis, which is a recession indicator. And so that sort of thing might be a headwind to commodities. But let me go back to the 1970s. And again, we're of course not as commodity dependent as we were in the 70s. But the thing that did the best in the 1970s was the consumer price index, but you can't invest in that. But something like oil, like gold, real estate, those sort of things have done well. Now, one of the reasons I like talking about gold is because gold is so much simpler. Right? If you go to silver already, you have so much industrial influence that it's just much more complex, right? And so if you go to some of the other commodities, agriculture commodities, that the dynamics are just far too complex for us to capture in here. And regarding the Fed, what the Fed really cares about, the Fed cares about that inflation doesn't go out of whack. And so they lost that battle of late. And so they have to recapture that, which is now a higher priority. Other than that, they care about financial conditions. They care about the spreads of high yield, of junk bond markets versus the other ones. The Europeans care about the Italian debt or whatever it may be, right? They care that the wheels are not falling off. And so as long as the wheels are not falling off the cart, they're okay. They don't care too much about the details of what copper is doing or the price of oil is doing. They look at it as an indicator, in part because some of these commodities influence inflation expectations. But they ultimately care that the banks stay in business. That's really the primary mandate. And they try to do that by not having the wheels fall off and by inflation being somewhat contained.
Mm-hmm. So how important are mortgage rates to the Fed? They've doubled them basically from 3 to 6% in less than a year. So has this had the intended effect of slowing demand on the housing side?
Yeah, that's an excellent question. It certainly should, right? I mean, consumer spending is 60%, 2/3 of the U.S. economy, and the mortgage market historically has a big impact on that. Clearly, that is a significant sledgehammer that was kind of thrown there. Now that said, in a stagflation environment, real estate tends to do all right because there is still a push for higher prices. Rents will continue to increase. And so we don't really see necessarily the collapse in housing prices. But yes, they have a very blunt instrument. And at the same time, we haven't seen other financial conditions tighten as much. But so does it have the intended effect? Well, we'll have to see. I mean, ultimately, we've had the supply shock, and everything is out of whack. So we overbought certain things, but then we didn't consume enough services. We didn't do this and doing that, and so it's very, very difficult to try to gauge what it should be. my own view, to just make that reference, in 2008 and beyond, I've said the best short-term policy may be a good long-term policy. And so when you say, hey, does whacking the housing market do the right thing? It addresses a symptom, right? So again, what's missing is a longer-term strategy of how exactly they're going to do this. And part of the reason we don't get this long-term strategy is because the Fed thinks that having this flexibility is so important. But having this flexibility got us into this trouble in the first place, where they had this groupthink and thought they knew better than everybody else does.
Mm-hmm. So, Axel, is it possible that we've hit peak inflation here? This seems to be the main objective of the Fed at this point. So when do you think they will try to claim victory on inflation and try to navigate their quote unquote soft landing or react to recession worries?
Yeah. What your question implies is that it's linear. And that's where I got the problem. I do think that the year-over-year comparisons are likely to come down in some areas, because I mean, used car prices can't go through the stratosphere forever. And by the way, we're not going down; it's just the yearly increase is going to go less. But again, I go back to the thing that high inflation is not linear. If you go back to any inflationary period, even after Volcker broke the neck of inflation, we've had wobbling inflation numbers that weren't. We didn't go back to 2% and flatlined there. We've had significantly higher inflation for an extended period. And so, and yes, the question is, will the Fed declare victory? For the short term, I think the Fed is so petrified that the market has risked losing confidence that they have to act tough. And so that means the next Fed rate hike. Who knows? Maybe they make some acknowledgments to a slowing economy. Then we have Jackson Hole coming up, the big love fest of the Kansas City Fest, where Powell again has to talk tough. But then the question is, will we see a pivot, right? We only then have the next Fed meeting in late September. As a reminder, most of the time when the Fed has peaked hiking, it wasn't priced into the market, right? Just a few weeks ago, the last rate hike was supposed to be in a year from now, then late last year. And so that thing can move fast forward very quickly. And so if the hiking of the rates cools down the mortgage market sufficiently to, and by the way, the mortgage market is important, but it's not as important as it was pre-2008. And so the question is, if they think that the economy in September, it could well be that they think economic growth is more important. And then we go back to Larry Summers said the other day, when you take antibiotics, one of the worst things you can do is to stop taking them early, right? And so that risk is very, very high. And so when you ask me about peak inflation, I say, yeah, maybe, but don't bet on it, right? Because we don't know how this is going to unfold, but I would not be surprised if the Fed is going to pause here or stop and maybe, quote unquote, declare victory. And then it's going to work fine for a few months. And then guess what? We're going to get whacked again, because we haven't structurally changed anything. I mean, we really need a change at the leadership at the Fed for the market to regain proper confidence. Because I don't see any chance that Powell is going to resign. Right? They're gonna keep the current framework, which I don't exactly know what it is, because I don't think there is a proper one. And again, because they haven't acknowledged that there is something fundamentally wrong with the framework they introduced. And as long as they stick to that sort of attitude, I don't think how you can regain confidence in the underlying factors, and that includes then ultimately inflation as well.
Mm-hmm. Yeah, that's a good point, that the Fed is in some ways just reactionary to whatever negative metrics that they're seeing, rather than being more long-term focused.
Yeah, and the Fed, of course, has rarely ever been accused of being too much worried about anything than the imminent problem, right? Mm-hmm. And so that seems to have been okay for them. Mm-hmm. But it's not helpful when things are unstable, right? It's okay when everything is in order, but bad policy is not good when you have high inflation. Mm-hmm. So it's okay to have bad policy when it doesn't really matter, but it's not okay when things do matter, when you have high inflation.
Mm-hmm. So as we've seen rates in the US climb, what effect has this had on the business cycle? Do you think that we're already in a recession?
Depends on who you talk to, right? I mean, if your neighbor loses a job, it's a recession. If you lose a job, it's a depression. It's one of these things. I mean, we are in an environment where everything is out of whack. And so again, recession sounds like linear. Not everything happens at the same time. I'm talking to you from Silicon Valley, and lots of tech companies have had hiring freezes. The big social media company here, they like many others, overhired because they were afraid, and now they've stopped hiring young people, right? And tell the other youngsters that we're going to have very tough evaluations, and if you don't make the cut, you're out again. And then I mentioned to you offline, right? I have a college dropout daughter who is on her second startup, and she says, finally, I can hire people again because some are available. Now, obviously, that doesn't mean there is enough workers working in restaurants, right? There is, on the service side, still amazing shortages. Everybody has heard about the delays in aviation, right? In aviation, you just can't hire and fire at will. Lots of people were offered early retirement during the pandemic, and now everybody wants to go back up into the air. So you're going to have these bottlenecks that are inflationary, right? Ultimately, these things are inflationary. So it depends on the sector of the economy you're in. And by the way, one word on quote unquote recession. First of all, in the US, it is not 2 quarters of negative GDP growth. You have a committee come out deciding on a whole bunch of factors. So if they don't think it's a recession, it's not a recession. So, and of course, by the way, they only announced it with a year delay. So I don't know how helpful it is to even talk about the term. We have certain elements that are recession. The second time yield curve is inverting, that's usually a very bad sign, right? But at the other end of the spectrum, the Fed the Fed wants to beat inflation. They don't want to have a recession. And so they will probably back off saying, okay, I think we've done enough, right? Mm-hmm. What they need to do is, a few months ago, we had 2 job openings for every job seeker. That is just completely nuts. It's completely inflationary. They have to get that back in line. And of course, you can do it on both ends, right? If people post-COVID go back to work, either because their portfolio shrunk, so their early retirement is out of the window, or because the daycare is open again, that gets people back into the labor force. And so looking at those numbers as we evaluate we're talking here before the jobs market is released, but looking at those sort of things is going to be important. But at the same time, yes, the Fed has to induce a recession to help get this thing back in balance.
Mm-hmm. Yeah, and exactly as you're just saying, we're speaking here on the morning of Thursday the 7th, and I'm just wondering how important those jobs numbers that will be released tomorrow are to the Fed.
Well, to the nerds, they're very important because they will give clues and they will give excuses, right? Again, it's the headline numbers are less important than looking at the details in this case. The labor participation rate, right? That sort of thing. Are people coming back to the jobs market? Because that tends to push up the unemployment rate as well. And so I wouldn't be surprised if the glass is going to be half full looking at that report. I say that with egg on my face, probably as people are listening to that, but there's a significant chance of that because it says, all right, can the Fed have an excuse here to be less tough? Because we have the FOMC minutes released where they're of course very old. Since then, the market has had a tantrum. Inflation expectations have come down. More important will probably be upcoming inflation numbers, but the next phase is there going to be an excuse for the Fed to take it slower? Mm-hmm. And I don't think much is going to change on the next rate hike. That's probably going to be another 75 basis points. But we may well get a signal that that's enough for now, because the Fed already said a few months ago they'll hike a bit and then wait, right? And so it's towards the end of that hiking cycle where the market usually has a relief. And so we're just talking in theory here, but and then the other thing not to forget, when you look at the media reports, they come after the fact, right? They look at what happened and then they'll tell you, oh, this was so obvious, right? And that's kind of when you cover the beat as a journalist, that's what these folks do. They'll talk to the ones who adjust the story to what the market is doing. And the one thing I can tell people is that look at the longer term picture, right? We are in this unstable environment. You'll have some things that are good and bad for the market. Keep focused on what you think you want to do and then test your thesis. But don't change your mind every 5 minutes based on the latest economic data.
Yeah, revisionist history always has a way of looking and explaining the story a different way, right?
Oh yeah, no, absolutely, and that's and especially, I mean, you're going to listen to the news that you like, and then just be convinced of that's going to happen. Have a framework like the real interest rate framework. I don't think is a bad one, right? Where do you think real interest rates are going to be over the next several years, not the next several months? Are we going to have an environment where real interest rates are going to be at higher? My own view is it's just not possible with the sort of debt levels we have. Also, we haven't even talked about it. I mean, we got a war in Ukraine, right? We got to have the world be more hawkish. We have deglobalization happening. All of this makes doing business more expensive for the business side, and for the governments, they got to spend more on defense and other things. We got to replenish all these these rockets and other things we've given to Ukrainians, right? And so all of that is going to be expensive. And I just don't see how real interest rates can sustainably be in very significantly positive territory.
Well, that's actually exactly where I wanted to go next. Could we see a change in the fiscal tightening that we've seen over the past several months due to the need of more defense spending if, let's say, we see the Taiwan situation with China start to heat up?
Well, not sure where it's going to come from, but yes, the world is a less stable place than it used to be. I mean, just take the rise of the U.S. having played kind of policeman in the world has enabled globalization, has enabled global peace. But it's the peace the U.S. has had an interest in. It's not the globalization part of it, right? And so now that the U.S. to an extent is overextended, to an extent that China's military might has risen, to the extent that Russia is not playing by the rules, that will cause a greater fragmentation. And there are lots of folks who don't like one another. I mean, most folks in Asia don't really love the Chinese. And the Chinese are hugely dependent on importing just about everything. And so if the seas are less safe because the US is not making them safe, that's going to increase the cost of business there. It's going to increase tensions. And so all of that, to me, is just that, again, I mean, I talked about the 70s having lasted a decade because inflation isn't, because policymakers have the wrong reactions. Well, the same thing is, right, deglobalization, just in case production rather than just in time production, all of that is inflationary. And so maybe we'll have a Fed that in that environment will have high real interest rates. I just don't see that happening in the medium term.
So to your earlier point, does the action of sending, $40 billion of aid money to Ukraine fall under that same category of this deficit spending?
It's a symptom of that, right? It's a symptom. The US can afford the 40 billion, but that's not the end of it, of course, right? NATO, I mean, anybody who's going to have a voice in NATO is going to be a hawk in the coming months, if not years, right? I mean, Germany is going to rearm. Historically, that has led to some interesting outcomes, right? It's everybody is in the mood right now that we got to do more, and I think that's absolutely the right thing to do. But things are complicated when it comes to national interests around the world, right? And it's not just the Europeans, other countries as well. And in the meantime, right, we can't export food from Ukraine, so we're going to have famine. Right? The Arab Spring didn't happen because they love democracy. It happened because they were starving. And so now maybe it doesn't matter if there's a revolution in some weak country somewhere in Africa or something. May not matter to the US market or to the price of gold, but these are all just signs that we're moving towards an era that's less stable. And we'll have to see what happens in this context, right? On the positive, by the way, and I unfortunately don't see that happening. The way to counter that is you got to make an investment and create an investment environment that fosters long-term investing, and you can do that with clarity of rules, cutting red tape, and things like that. Now, if you tell me when era of that, then real rates are going to move higher, right? That sort of thing moves real rates higher, and that's part of the reasons why for a while in the Trump years, when the tax reform was discussed, the price of gold wasn't doing so well because real rates were doing better because it was more attractive to make long-term investments.
Mm. So to contrast the Fed's hawkish stance, Axel, what is the situation that the ECB is in? Do you think that they're in a more difficult situation to navigate because of the differences between the value of the bonds of all these different countries in Europe?
Well, it depends on what you want to achieve. And Madame Lagarde, the head of the ECB, I think she wants to achieve a green Europe. I mean, Europe is interesting. The ECB is the only effective agency in Europe, really. Everybody else is a huge bureaucracy, which means the ECB has been tasked with just about everything. And the ECB is becoming the fiscal authority in Europe, is becoming the green agency in Europe, is becoming everything. The one thing they don't seem to be doing is worry about inflation too much. So expectations about rate hikes have already been toned down because there's a slowdown in economic growth. I mean, some of the Baltic countries have inflation of 20%. It's incredible, right? German inflation and the other ones are high. Now you talk about the kind of the periphery, and they have concerns about it. One of the things we like to look at is when you raise rates, you tighten financial conditions. So you, by definition, increase the spreads, the cost that the weaker players are paying for their debt. That means Italian debt, Portuguese, Spanish, Greek, they pretty much have to rise disproportionately. What you, in my view, ought to watch as a central banker is you got to watch about the fragmentation risk. You got to worry about, can the Eurozone break up? And so for that, rather than looking at the levels, you should look at the correlation, meaning if there's a flight into bonds and a flight out of Greek bonds, that's a concern. If then you do whatever it takes if you're Mr. Draghi, right? But the mere fact that those rates are rising a little faster shouldn't matter. And so the ECB came out the other day and said, we'll watch it closely and whatever it is and bring down the rates again. They continue to do this thing where they try to micromanage the markets with talk. And that just builds a pressure cooker. So I don't think that's very helpful. I kind of like it that the individual countries in the Eurozone have to worry about their own house. And of course, with the ECB doing the job for them, the pressure is off those national governments.
Mm-hmm. So is this one of the main reasons for so much of the relative dollar strength that we're currently seeing?
Well, that's part of it. I mean, on the good news side, we finally have a greater dispersion, right? Meaning some countries are raising rates, some not so much. The dollar, by the way, on a purchasing power basis is the most overvalued since the early 2000s. And so if we have peak now in our cycle and the other countries have not, I wouldn't be surprised if that is actually going to reverse, because our cleanest shirt may be very clean, but it's all priced in. The dollar index is hugely biased towards the euro. And of course, I should mention that again, right? Ukraine is around the corner from the Eurozone. And with that, the gas supplies, huge problems with the energy policy in Europe. The EU finally suggests that maybe nuclear energy is a sustainable energy for the environment. It's the only sustainable energy for the environment, probably in the medium term. But if you kind of make yourself dependent on Russian gas, and suddenly things don't work anymore, surprise, right? Even in France, where they have a lot of nuclear energy, many of the reactors are offline for maintenance and corrosion issues. I'm not the expert on that, but why don't they have a warlike effort to try to get these things back online, right? They don't take this stuff seriously enough. The energy companies are getting bailouts, getting nationalized, in part because they haven't received the supplies they needed, so they need to buy on the open market, but they need to they have contractual obligations to deliver the energy, and so in Germany and France they get bailouts, or in France get nationalized. So it's a mess out there, and that does have an impact. The other thing is, of course, the dollar is a carry currency, meaning that when there's global expansion, the dollar tends to weaken as people borrow dollars to invest in other countries. The one thing we haven't mentioned is China. The Chinese, at some point, you would think, are going to get over their zero COVID policy. They're easing, and they're trying to. They mentioned some enormous growth targets, right? That's going to be a trend against that. And so, if you think that the Fed is going to be at the peak cycle soon, and China is going to be expansionary, that may well weaken the dollar just when everybody thinks the dollar is going to conquer the world again.
Mm-hmm. Yeah, it's an interesting point. Axel, before we hit record here today, you and I were talking a little bit about the stagflationary fund that you run. So how do you look at, let's say, the framework for investing in a stagflationary environment here?
Yeah, so in May, we launched the Merk Stagflation ETF on the New York Stock Exchange. And we put that fund together because we thought, well, how do you invest in a stagflation environment? Of course, you can invest in gold, you can invest in cash. I mean, why not, right? But we looked at what asset classes did well in the 70s, recognizing we're not in the 1970s. So we looked a little bit broader and looked at what sort of assets or asset classes do well when inflation or inflation expectations go higher, and then see, can one simplify that? Most equities don't do particularly well. And so in that ETF, we invest in gold, oil, real estate, and inflation-protected securities. And the first three of them, it's a rules-based ETF. It follows a trend-following system that adjusts the weights of gold, oil, and real estate. And the reason we use a trend-following methodology is because that worked particularly well in the 1970s. And so we think we might be able to add some value there. And so we package it into a simple ETF. And the net result may be something that's closer related to how inflation behaves over time. And so it's a tool, it's a diversifier. Some people look at it as a bond alternative because there's a fairly heavy weight of the inflation protected securities. And with that, people might use it as a bond substitute, which is still very, very difficult to get a suitable bond substitute. But also it might be a pure stagflation play as well. Yes.
Mm-hmm. Interesting. Axel, is there anything else that you think is worth mentioning today?
Lots of it. How many hours do we have? I mean, we mentioned it, right? We have a midterm election coming up, probably gridlock in Congress, which means less fiscal spending, which in some ways is a headwind to growth. But we're not going to get the fundamental reforms, right? It's again, the symptoms don't matter as much. The long-term strategy matters. What we need is a long-term plan, both on the monetary side and on the fiscal side. And I don't see that happening. And then the other side of it is, these things are not linear. Don't expect inflation going up and then gradually down. This is going to be a bumpy ride. And the one thing to watch is what's going to be the next mistake, so to speak, that comes out of Washington.
Yeah, it's like I said before, I feel like a broken record starting every interview saying that we live in interesting times, and it probably feels that way all the time.
Well, the one thing I like to tell people is, people ask me, what do you want to invest in? I says, well, invest in your health, because this is going to be rough. And so you might as well. You are the best income generating machine, right? Don't outsource this by clicking something and buying something on the exchange. Well, if you can remain healthier longer, you can earn an income longer, which means you have an ability to sustain this environment longer. And so I think that's something we underestimate sometimes, that this is it's going to be a rough time, but control the variables that you can control. You can control your expenses, you can control your health, to an extent anyway. And so try to make the best of those sort of things. And then try to keep your spirits in all of that, and only listen to programs like this on the ground floor, so that when you jump out of the window, you don't hurt yourself. That's the sort of advice I can give. Yeah.
Well, Axel, I think that's excellent advice. Yeah. Of course, you're available at merkinvestments.com and on Twitter at Axel Merk. Axel, thanks so much for your time today. Really appreciate your perspective.
Yeah, great talking to you. Have a good one.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.